Hello traders, Gary Wagner here just before 1 o'clock in Honolulu, 7 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is the 17th day of April, 2020, and this is the daily report for gold and silver, our weekend review, and a special report on top of that. This has been a most interesting week in the financial markets as a whole. The equities have continued to rise in light of the fact that we are still in a full-blown pandemic with no vaccine or cure available. We have had our country, along with other countries around the world, be in virtual lockdown now for 3 weeks to a month, and life goes on. On today's show, I want to look at our current trade that we accomplished last week. We took some sizable profits, $13,500 per contract, but more importantly, speak to the current correction because we got out quite some time ago. The market's trading at $16.94. We exited our trade at $17.37 after entering it at $16.02. We'll talk about that in detail, but first to the price board. Gold broke strongly to the downside on a report that was optimistic about a drug company coming up with some sort of treatment for the COVID-19 virus. Gold is currently down $37.20, with June futures currently fixed at $16.9450. It's not like we were unaware of this. As you know, we pulled profits earlier this week, and when we look at our technical studies, we will talk about what key indicators caused us to issue the signal to cover and take profits on our long position. We had spot gold also down about $35 on the day, $16.84. When you compare that to $16.94, which is futures pricing, we can see that over this last week and a half, we saw a $60 spread between spot and futures narrow to about $4. And despite the fact that the dollar was weaker on the day, the entire precious metals complex, those metals that are traded on the futures complex, did lose ground today, although in many cases nominal ground. A $1.80 decline in platinum, $7.9150. When we look at palladium, that actually lost about $20 or a full percentage and is fixed exactly at $2,100. And then silver price drop today was almost 2%, a 29-cent decline. Currently, we have May silver at 15.33.5 cents. And as I said, that was all in light of a weakening U.S. dollar, down about 0.3%, back below 100 at 99.77. Equities were as a whole higher, 700-point gain in the Dow. Standard & Poor's gained about 3%, and the NASDAQ Composite gained 1.38% on the day. Let's take a look at our technical studies. On today's show, I want to accomplish two things. First, a quick review of the trade that we entered back on the 1st of April and exited earlier this week. And then, most importantly, where we think this correction could go to, because it is my belief that this sell-off will be short-lived at best. So, first to our trade. The interesting thing about the trade that we put on in April was that it began and ended with the same pattern type. I am circling right now the entry point that triggered the buy signal. It was created from that 3-day pattern, a three-river morning star. The market moved from 1602, which was where our entry price is, and if you take a look at it, we entered really on the day of the Doji and then saw the market move up for 1, 2, 3, 4, 5, 6, 7, 8 consistent days before starting to track lower. And the other interesting thing is that we covered based upon the identical pattern, which was a three-river evening star. Now, the criteria is exactly the opposite. First criteria is that it occurs after a defined downtrend. We can certainly say that that was in place as this market went from about 1682 down to these lows at 1577. The first criteria of an evening star is exactly the opposite. It must occur after a defined uptrend, and we can certainly see that it met that criteria. In the case of a three-river morning star, you have the market in decline, And what happens is you get the first day of that pattern being a long red candle that will typically make a lower low and a lower high than the previous one. So you think that the trend is still fully intact. However, on the following day, the market opens and closes below the close of the prior red candle, and if it is a doji, meaning where the open and close are the same or a tick apart, it gives that pattern more credence, and it's simply called a three-river morning star, but it does contain a doji. Now, the third candlestick required is a long green candle that gaps above the star that formed the day before, and that's where you get this three-river morning star. Now, typically you would wait for confirmation, and confirmation would come in form of a green candle with a higher high and a higher low. We got that, although it was a small-bodied candle. The large-bodied candle occurred on the following day. The market literally ran from 1602 up to this top at 1788, and it was during this top that market technicians got the first indication that we could in fact be looking at gold prices being overbought. And the reason I say that is, yes, it did come in and make a new record high for the year, but it closed well below that. And so the fact that it traded to a high but didn't close near the high told me that there was profit taking that was moving in the market. The fact that it was in a evening star position, because before this red candle occurs, you still have a doji in an evening star position, just not a three-river evening star. That really told us that this market could move lower. So we did raise our stops. We took our stops. I believe they were sitting at 1721 and moved them to 1737. That would be approximately this price point. And as you can see, we were knocked out with a pretty decent profit. In fact, we made $13,500 per COMEX contract. Which brings us to the most important question we can ask ourselves, and that is, if we believe that this correction will be short-lived, at what price points should we consider a possible support level coming in? Now, the first level that we really want to look at is the 50% retracement, and this retracement, of course, is from 1577 up to this high at 1788, and it occurs at 1682. The other thing about this particular price point is you see this series of bottoms coming into the market right here, and that tells me that at some point that price point was an area of support. We can then genuinely take that line and draw it across our screen to see if it acted in any other way. And in fact, it did, because right here, we can see that it was a point of resistance. There's absolutely no doubt about that. And these two tops here, this was a set of tweezer tops that we talked about. Well, that was actually showing that this price point, meaning 1682, was absolutely a level of resistance here and here and support here. The level below that is 1657. Now that is a 61% retracement level. And when we draw our line across and look for areas that would confirm that there is some importance to that price level, we simply have to look at the three-river morning star. We have to look at these tops here, and we can see that as the market traded below that, and then on this final candle, which was our confirming candle, it was the following day that we had a pretty solid release of energy and a solid move to the upside. So that also has some importance. My sense is that we certainly are going to go into the weekend flat with no active trades. The question is not if, but where gold will find support, because that will be a key determining factor as to our next trade. This has been Gary Wagner, wishing you, as always, good trading and stay healthy. We'll talk to you on Monday for the next daily update and review. Bye-bye.